Fine. Let us take up this question now. Hold Limited acquired 100% ordinary shares of 100 each of subsidiary limited on 1st of October. On 31st of March 18, the summarized balances of two companies were given as below. So what is the uniqueness of giving you 100% subsidiary? There is no non-controlling interest. You can write just as a matter of practice. Calculation now becomes much more simpler. Either it goes to goodwill calculation or it goes to non-PL calculation, only two columns. And acquisition happened on 1st of October. The balance sheet is given 31st of March. So acquisition took place during the year. So the profits we have to divide into pre, post, and all number of months should be kept in mind. Okay, non-current assets, we have land and building, plant and machinery, investment in subsidiary. Current assets, we have inventory, then financial assets, trade receivables, cash and cash equivalents. Okay, in the liability side, equity share capital, other equity, other reserves. Okay, we have other reserves and retained earnings. Current liabilities, we have financial liabilities, overdraft, and trade payables. Okay, quite a few line items. The retained earnings of Sublimited showed a credit balance of 6 lakh on 1st of April 2017, out of which a dividend of 10% was paid on 1st November 17. Hold Limited has credited the dividend received to retained earnings. There was no fresh addition to other reserves in case of both companies during the current year. There was no opening balance in the retained earnings in the books of Hold Limited. Following are the changes in fair value as per the respective Ind AS from the book value given on 1st of October in the books of Sub Limited, which is to be considered while consolidating the balance sheets. Fair value of plant and machinery 40 lakh, rate of depreciation 10% per annum, land and building appreciated by 20 lakh, inventories increased by 3 lakh, trade payables increased by 2 lakh. Prepare consolidated balance sheet on 31st March 18 as per Ind AS 110. This was an exam question, May 2018, 15 marks question. These are the kind of questions when you see, you get realizations in life, right? Especially when you see these sudden questions in examination. First of all, many people don't read consolidation question in the exam. That is a different question. But what happens usually is when you're in class, no, everything goes simple, smooth. But examination, this kind of question comes. I always say that class is like film theater. You go, you sit, you enjoy somebody else performing on the screen for you, literally online sessions. You are just enjoying somebody else solving the problem. It is somebody else performing. You just need to relax and enjoy. But in examination, it's not film theater, it is operation theater. Surgeon called as institute, question paper called as injection or anesthesia, and of course, patient called as student will be in examination. As long as you're in the examination hall, you don't feel the pain. Anesthesia is on. You come out of the exam theater, operation theater, whatever you call, examination hall, you start discussing with your friends. That is where anesthesia starts coming down. You start feeling the pain. After 2 months, result comes, operation success, patient died, passed in all the subjects, still examination not cleared yet. Anyway, I wish it does not happen. Uh, I will give you few minutes, read this question, and you try to analyze in your mind what and all can be done. If you can start solving, you go ahead, but I'll also solve it, don't worry. But I just want you to give some time for you to think. Before I take you to my route, I want you to think. So, see to what extent you can understand and you ask questions. Let's see, I can go by that angle. You have solved few questions also by now. So, you should be able to think to an extent. So, please try. At least the working notes, what are thoughts at least? try to arrange in one place. Okay. Let's read the sentence, and based on the sentence, I'll address your doubts. Retained earnings of subsidiary limited showed a credit balance of 6 lakhs on 1st of April. Retained earnings of subsidiary limited. Let's look at subsidiary limited column. Let's look at retained earning row, and the balance sheet amount is 16 lakh 40,000. So opening balance 6 lakh became 16 lakh 40,000. If 6 lakh became 16 lakh 40,000, we can say that whatever 10 lakh 40,000 is the profit earned during the year, and that 10 lakh 40,000, because acquisition took place of during the year, we will divide this into pre and post, and out of which a dividend of 10% was paid on 1st of November, dividend payment. So this 10.4 lakh calculation is not correct. What should be the calculation? Whatever dividend paid during the year or dividend paid after acquisition has to be added back. You remember the calculation format that we follow? We will calculate the reserves or P&L, whatever you call it, before dividend. Therefore, any dividend payment I will add back. Dividend paid 10%, 10% of capital is 40 lakh. So 40 lakh 10% means 4 lakh. Therefore, the closing balance, I don't want to take it as 60 lakh 40,000. I will take it as 20 lakh 40,000. And 20 lakh 40,000 opening is 6 lakh. That means balance remaining becomes 14 lakh 40,000. Dividend paid will be added back. So I will have reserves before dividends. Hatch Limited credited the dividend received to retained earnings. Absolutely fine. That's what as per Ind AS 27 says. No question of pre-acquisition, post-acquisition. Entirely taken to retained earnings account. There was no fresh addition to other reserves, which means other reserves we had 20 lakh, and this 20 lakh is entirely opening balance. No addition during the year. There was no opening balance of retained earnings in the books of Hold Limited, does not matter. Opening balance of current year of Hold Limited holding company does not make any difference. Following are the changes in fair value. Changes in fair value means revaluation adjustment. We'll take it one by one. Fair value of plant and machinery was 40 lakh. Okay, 40 lakh is the fair value. What is the book value? Okay, this is where certain assumptions has to be made. Reasonable assumptions. So before I tell those assumptions, I want to know whether you can come up with those and the calculations. They have given you fair value. We have to compare with book value. What is the book value on the date of acquisition? Date of acquisition is 1st of October. How do we do it? Fair value treated as book value. If you treat fair value book value same, then there is no revaluation adjustment to be done. Okay, so we will come to what value we have. If you look at the balance sheets of subsidiary limited, sub limited, you have plant and machinery 27 lakhs. So we will assume that there are no purchases during the year, no sales during the year. So for this closing balance, if I add depreciation, I get the opening balance, assuming no purchases, no sales during the year. And from the opening balance, for a period of 6 months, you subtract depreciation, or you can add back only 6 months depreciation. That's also fine. Ultimately, you need book value as on 1st of October. So that assumption we'll have to make. And we'll calculate accordingly. We get revaluation profit or loss. And then correspondingly, we will have depreciation. Revaluation profit, pre-acquisition profit. Depreciation, post-acquisition element. And the treatment follows. What about land and building? Revaluation profit, but corresponding depreciation, no information, neither on opening balance, nor on closing balance, nor on depreciation. So you can't make any assumption here. The only thing what we do, whatever the revaluation profit, only pre-acquisition and corresponding amount in balance sheet, no question of any depreciation. Inventory increased by 3 lakh. This will be, of course, again revaluation adjustment, a fair value adjustment, it will be pre-acquisition, and inventory increased by 3 lakh. So when we prepare the considered balance sheet, the incremental amount 3 lakh will get added to the stock, to the inventory. Trade payable increased by 2 lakh. Again, we have to consider as fair value adjustment. When trade payable increase, it's a loss. So it's a minus number in pre-acquisition treatment. And trade payable increased. So corresponding amount we will add when we prepare the consolidated balance sheet. On the liability side, trade payable, this amount gets added. We'll come to the calculation part of it. But before that, I would like to address if you have any doubts or if you need any clarification.
So,
The dividend part, what we have discussed, that is after this balance, out of this credit balance, 6 lakh was the opening balance. And out of this balance, 10% dividend is paid. So I cannot say 6 lakh has become 16 lakh 40,000 because this 6 lakh is before subtracting dividend, whereas 16 lakh 40,000 year end amount is after subtracting dividend. But keeping it aside, whether out of opening balance or not, that will add confusion in examination. So the approach what we follow For the straightforward, whatever may be the dividend paid out of opening balance, out of 1 year back balance, current year balance, does not matter. Whatever the closing balance is there, you add back dividend, so you get all the reserves before paying dividend. And therefore, all the calculation becomes smoother, and we're adding it back now. And in our working note format, we subtract dividend paid. So addition one effect, subtraction another effect. Correspondingly, it will be taken in the different place. uh, pre-acquisition is, I mean, 6 lakh is the opening balance, and then closing balance is 16 lakh 40. So 16 lakh 40, if you add 10% of 40 lakh, 4 lakh. So 16 lakh 40 plus 4 lakh. So closing balance actually before reserves, before dividends, I can say it is 20 lakh 40,000, and opening balance is 6 lakh. So 20 lakh 46 lakh means current year profit will be 14 lakh 40,000, which will divide this into 6 months and 6 months. If you need any other clarifications. Okay, let's go further then. Fair value adjustment calculation, plant and machinery, as per subsidiary, group difference, same structure we are going to follow. As on 1st of April 17, we don't know the balance. Depreciation on 1st of April to 1st of October, 6 months depreciation. You get WDV on the date of acquisition. Then depreciation for remaining 6 months, what you get WDV at the end of the year. And we have this number as per the balance sheet given. This 27 lakh is as per the balance sheet given. Assuming there are no purchases, sales during the year, and depreciation was the only cause of impact, you work backwards, and what would be the opening balance? If I take 100 rupee at the beginning, depreciation at the rate of 20%, right? Depreciation 10%, depreciation machinery 10%. Therefore, you take 100, 10% for 6 months. So what you get is 5, it becomes 95. Again, same 6 months, again 5. So what becomes is 90. This 90 represent 27 lakh. How much is the opening balance? Actually, I can do on WDV also, but anyway, cross multiplication, right? If 100 is the opening balance, 90 will be the after depreciation closing balance. If 27 lakh is the closing balance, cross multiply into 100, divide by 90. What should have been the balance? Assuming no purchases, no sales during the year, 30 lakh. To provide depreciation, 30 lakh into 10% into 6 by 12, 1 lakh 50,000. Again, depreciation 1 lakh 50,000. That's how you get 27. And this 28 lakh 50 revalued at 40 lakh. So revaluation profit of 11 lakh 50,000, and depreciation post acquisition 1 lakh 50, and on 40 lakh if you apply 10% for 6 months you get 2 lakh. So incremental depreciation 3,000. Okay, so write down this part, and then we go for other small fair value adjustment. 1 minute. You can write down. Okay. Other fair value adjustments will come straightforward in the balance pre-acquisition calculation. Let's do that. Instead of writing one by one line item, we are having machinery, building, trade payable, stock. We can write four line items, but anyway, same proportion we do. Everything is going to be on the date of acquisition. Everything is pre-acquisition. Why not present it in one amount? You want, you can present separately, you can do it. So plant and machinery, we got 11,50,000, this difference. Then land building increased by 20 lakh, they've given. Inventory increased by 3 lakh, they've given. And trade payables increased, meaning net amount with respect to the fair value calculation, I'll subtract. So what I get is 30 lakh 50,000 fair value adjustment as pre-acquisition on the date of acquisition. Write down this part. Okay. Then regarding analysis of profits also we'll do it. Pre-acquisition, post-acquisition. So we have retained earnings of subsidiary, closing balance we have 16 lakh 40,000. Other reserves, no change. Entire other reserves pre-acquisition. Only thing is retained earnings. 16 lakh 40,000. Add dividend paid. In as per AS21, we used to think lot whether dividend paid out of opening balance, out of current year profit, so pre-acquisition dividend, post-acquisition dividend, none of those things to be worried here. So dividend paid at the rate of 10% of share capital of 40 lakh. Okay, so 40 lakh 10% means 4 lakh. So what you get the amount before paying dividend. What is the gross reserves? What we get is 20 lakh 40,000. And this we can compare what is the opening balance and what is the current year balance. Opening amount is on the date of acquisition credit balance of 6 lakh, lakh, and therefore current year amount is 14 lakh 40,000. And this 14 lakh 40,000, because the acquisition took place on 1st of October, I will divide this into 6 months, 6 months. So you get 7 lakh 20,000 and 7 lakh 20,000. And logical aspect, why I do like this quickly, because if I don't consider dividend like this, like we did what calculations earlier, I end up doing 6 lakh comparing with 16 lakh 40,000. But 6 lakh is before paying dividend, 16 lakh 40 is after paying dividend. You see, they are not directly comparable. Either both should be before dividend or both should be after dividend. There's also one more way of calculation possible. Huh? What you can do, because it is paid out of opening balance, 4 lakh, I can take out from 6 lakh. It is paid out of opening balance. So 4 lakh, if you take out from 6 lakh, balance you get is 2 lakh. If 2 lakh should become 16 lakh 40,000, that is also 14 lakh 40,000. You see, you get the current year profit, same thing. But whether it's paid out of opening balance, paid out of closing balance, why that headache? Whatever the dividend paid, you add, you get the balance before paying any dividend, then you know opening balance, current year profits, calculation becomes smoother. This is the easiest way. I hope you also understood the logic behind why do we do this calculation. Okay, and just keep it in mind always. Whenever you do one calculation, adjustment should always be in two places. See, 11 lakh 50,000, it came here. So which will be a pre-acquisition element, and 11 lakh 50,000 will come in the balance sheet. I mean, the adjustment of PPE. 50,000 depreciation one place here as post acquisition, and one more element we will take it in the balance sheet. PPE depreciation will subtract. 20 lakh land building, again two places, one fair value adjustment, one coming in the balance sheet, PPE calculation. Inventory, one fair value adjustment, one more while calculating inventory in the balance sheet, I'll increase by 3 lakh. Trade payable, one adjustment here, fair value adjustment, and one more I'll do when I prepare the balance sheet. The liabilities, trade payable, will be increased. And dividend, I added 4 lakh here. And one more place, I will be subtracting in the working note format. So addition in one place, subtraction one place. So the double entry effect is given in all the adjustments. So before we start the working note format, take a look at all these calculations, concepts, and logic, and see if you require any clarification. Same calculation. Yeah. Okay. Good. Okay, I hope all the adjustments are comfortable. Now let's do the working note format. As usual, the best part about this problem, there is no non-controlling interest. But as a matter of practice, you can still write. But even though it is not, compulsory in particulars amount goodwill, CONPL, NCI, subsidiary 100%. So nothing is relating to NCI. Share capital of subsidiary entirely to goodwill, other reserves entirely pre-acquisition. They only said that there is no current year transfers. Retained earnings, we have done the calculation, 6 lakh pre-acquisition, opening balance. Current year, 7 lakh 20, 7 lakh 20, pre goes to goodwill, post goes to CONPL. Then we have fair value adjustment and depreciation elements. Write down till here. Okay. Coming to the fair value adjustment, we have done the one line calculation so that you can take it as well. Entire thing goes to goodwill. Post acquisition depreciation, incremental depreciation, that is goes to CONPL. Corresponding thing should have been done in land and buildings. For lack of information, we are limiting ourselves only for plant and machinery. Dividend paid entirely will come in CONPL. Then holding company, investments from the asset side, investment in subsidiary entirely goes to goodwill. Other reserves, that is their retained earnings and other reserves, holding companies, all reserves and surplus comes in CONPL column, and you can do the total. See how much total you get. You get positive number, right? 37 lakh 57 70,000. So it is not a goodwill, it is a gain on bargain purchase. So gain on bargain purchase as well as this CONPL, both of them will be part of same heading. So we can do one more calculation below, that is other equity to be reported in the balance sheet will be 37 lakh 70,000 plus 62 lakh 14,000. Together you will show it as other equity in the balance sheet. NCI, nothing will come, that is zero anyways. Okay, let's go to balance sheet. And I think before balance sheet, we need to do one working note for PPE. But in fact, in this problem, not only PPE has fair value adjustment, even trade payable is there, inventory is there. So we can do in the same format other elements also. That is holding company amount, subsidiary company amount, adjustments we do, and the balance sheet amount. I'll go further. Holding subsidiary fair value adjustment or depreciation, basically adjustment, closing balance. Land and building 30 lakh, holding company, subsidiary company 36 lakh. Fair value adjustment is said, building to be increased by 20 lakh. No information on depreciation. Plant and machinery, we have done this all the circus and calculated. 11 lakh 50,000 fair value adjustment, depreciation 50,000 incremental. Other notes also there, as I told you, let's do that here itself. Anyway, write down till here, then I'll come to the other notes part. It would not come in conpil, it would come in goodwill situation because it is paid out of pre-acquisition profits. I mean, it is paid and before acquisition itself, it is coming. So conpil would not come if the dividend was paid before. Yeah, that would be the case. If dividend was paid before, it would come in the pre-acquisition column, that is goodwill calculation column. Recovery of investments will happen only if at the time of investment you knew there was a dividend announcement. That is, when you acquired on 1st of October, did you know that November the dividend is going to come? If that is the case, then you can say that it is a recovery of investment. The treatment will be accordingly. That is, you are going to consider it as recovery of adjustment, and therefore it will be affecting the goodwill calculation. It will be considered as impairment of goodwill. But you acquired on 1st of October, dividend paid on 1st of November. So usually there will not be 1 month gap between so much acquisition date and payment date. So we have assumed it is not a recovery of investment. Typically what will happen is there will be a AGM happening, and the acquisition takes place before that and dividend payment happens after that. So you need to have information about when the AGM is declared or when the announcement of dividend was made. In the absence of such information, let's not assume it as recovery of investment. If you assume it as recovery of investment, the treatment will change. The treatment will be the dividend payment. We will have to take it as impairment of goodwill. So whatever the goodwill we calculated now, that will get reduced. I mean, in this case, it will not be goodwill, it will be gain on bargain purchase. Okay. Now coming to other notes, inventory, holding company, subsidiary company, fair value adjustment, and then the closing balance. No depreciation will come in inventory. Receivable, there is no adjustment, but anyway we are doing all the things. Why not complete everything in one statement? So you can easily pick this number and put it in the balance sheet directly. Trade receivable from holding, from subsidiary, no adjustments, simply the total. Cash, holding company, subsidiary company, no adjustment, simply the total. Trade payables, holding, subsidiary, there is increase of trade payable during acquisition. You add, what you get is the closing balance. Borrowing also holding plus subsidiary closing balance. Anyway, write down till there, then we'll go further. Borrowings is that overdraft. Let me make it specific. The borrowing, that overdraft, we will be taken as short-term borrowings. Overdraft. Okay, let's go to balance sheet. PP, we have done the note 1.72 crores. Yeah, 1 crore 72 lakhs. Intangible, nothing, no goodwill. Inventories, we have done the note. Trade receivable, done the notes. Cash and cash equivalent, we have done the calculation. Share capital, only be holding company. Other equity, we have to calculate, include both con PL as well as gain on bargain purchase. Which calculation we have done? NCI, nothing, zero. Non-current liabilities, nothing is there. Trade payables, we have done the calculation. Adjustment was there, remember. Short-term borrowings, that is overdraft, uh, is overdraft part of short-term borrowings. That's all total on the asset side and liability side. Okay, that's all. You write it down. Okay, great.